The broadcast is now starting. All attendees are in listen-only mode.
We'd like to welcome everyone to the Zacks Quarterly Market Strategy Conference Call, a service of Zacks Professional Services Division. And if there are any first-time attendees out there, this is a live conference call featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, the market, and the economy, both globally and here in the United States. Our Chief Equity Strategist and Economist John Blank and Research Director Sheraz Mian will be our panelists today. John will give you everything you need to know about the market, share some investor advice as well, and Sheraz is going to preview the Q3 earnings season and give us the big picture on earnings. And this is something new that we're adding to this online call. If anyone in the audience has a question for either of our panelists, all you need to do is type it into the chat box, which appears on my screen anyway, on the right-hand side of your screen. We welcome questions, get to as many as we have time for at the end of their presentations. So, Sheraz, earnings have been on a roll lately, but S&P companies are lowering their guidance for the upcoming Q3 earnings season. So are earnings going to continue strong or disappoint?
Yeah, so thanks, Terry. Thanks for the intro. Excellent question. I think the key issue on the earnings front is that the picture, as you rightly point out, has been quite strong over the last many quarters, and what we need to see is reconfirmation of that trend. So yes, there are some concerning points along the lines of what you flagged here, but overall the earnings picture still remains pretty strong. And we could show you that if we go to the first slide in my slide deck, which shows the summary table, and you could see there if we bring up which is slide number 4. Can we have the slide? Okay, so 17.9% total earnings growth in Q3 year over year, and the year over year revenue growth is 7.3%. Just a brief point of explanation here as to what we mean by earnings. We're not talking about EPS. We are talking about the equivalent of net income. So net income estimated for individual companies, aggregated to the sector level, and then aggregated to the index level. All our discussion here is related solely to the S&P 500. So these are bottom-up S&P 500 expectations. So the third from the bottom row in this table gives you the aggregate picture for the index as a whole. As I mentioned, 17.9% is the earnings growth, 7.3% is the revenue growth, and the rest of the growth beyond what's coming from the revenue growth is from margin gains, as you could see in the extreme right side. So this table is basically showing the year-over-year change in earnings, revenue, and margins, and we contrast that with what was actually reported in the preceding quarter, the second quarter of 2018. The last two rows in this table shows the aggregate picture on an ex-finance and on an ex-energy basis. Since both of these sectors have unusual movements, it's at times useful to look at the data on an ex-finance or ex-energy basis. But if you scan this table, what what readily comes across is the breadth of growth, as you could see for this quarter. And if we go to the next slide, there we have the key points about this earnings season. So relative to what we actually saw in the second quarter and also in the first quarter, the growth pace is decelerating, and I do touch upon that deceleration trend a little later. But even then, overall growth is in double digits. As I pointed out, the strength is broad-based and not restricted to one or two sectors. 10 of the 16 Zacks sectors are in double-digit territory, including finance and technology, the two biggest earnings contributors in the index. As you know, finance and technology combined bring in about 45% of total S&P 500 earnings. So the fact that both of these major sectors have strong growth goes a long way towards showing the breadth and the overall strength. Energy, as has been the case in recent quarters, continues to benefit from easy comparisons and developments on the underlying commodity side. But even if we look at the aggregate picture on an ex-energy basis, growth is still in double digits. Only two sectors have year-over-year declines. Conglomerates, because of the persistent issues at GE, and autos because of tough comparisons at Ford. Other than these two, the rest of the 14 sectors are in positive, with 10 in double digits. So a lot of breadth of strength and momentum across the board. If we go to the next slide, it shows how expectations for the September quarter evolved since the start of the quarter. And what we are seeing here is another reflection of what Terry pointed out at the top about less than positive guidance from management teams. And as you see here, at the beginning of the quarter, growth was expected to be 19.6%. It has come down to 17.9% as of today. And even though it's not a very huge negative revision in the bigger scheme of things, estimates for 13 of the 16 Zacks sectors did come down. I do want to make a brief point about estimate revisions, and that is how revisions to analyst estimates have always been at the core of the Zacks research system. Our research and empirical research shows that estimate revisions have a very strong correlation with near-term stock prices, and this key insight is at the core of our Zacks rank and the Zacks recommendation. And even though the correlation is the strongest in the near term, I think this insight, our research and practice shows, can be as useful for folks that are of long-term nature as it is for short-term traders. And we have a practical execution of that strategy in the focus list portfolio, which is part of ZRS, but is available in greater detail in the ZAT PM platform. myself and Stephen Ralston, my colleague, we manage the focus list portfolio and make active use of trends and revisions to pick stocks. So if we go to the next slide, we'll tell you what's been happening on the revisions front. So the biggest negative revisions for the September quarter were for the autos, conglomerates, staples, and business services sectors. Technology, construction, and energy enjoyed positive revisions. The technology positive revisions were not across the board. We had positive revisions in some areas and negative revisions in others. Facebook, for example, suffered some major negative revisions following its last earnings release and less than impressive guidance. Apple, on the other hand, has enjoyed pretty strong positive revisions. Construction has very strong momentum, as we saw with Lennar's numbers this morning, and energy positive revisions is primarily a reflection of what's going on with oil prices. So one notable factor to keep in mind is that the prior 3 quarters, the second quarter of 18, the first quarter of 18, and the last quarter of 17, all 3 of those had stable to positive estimate revisions. So the negative revision that we saw in the prior slide for the September quarter is, in a way, a departure from the more recent trend on the revisions front. That said, the magnitude of negative revisions is modest relative to historical periods. And if we look at the revisions trend prior to the last 3 quarters, then the direction of change has persistently been to the downside, meaning estimates for the quarter would always be coming down in most of the quarters over the last 4 or 5 years, except for the last 3. So it's different relative to what we have been seeing recently, but not altogether out of line with historical trends. And one most obvious and major factor for what's been happening over the last 2 quarters is the direct impact of the tax cut legislation. So the major estimate revisions that we saw earlier in the year were primarily a result of that, and perhaps with that effect now having flown through the system, we are getting back to a more normal revisions trend relative to the recent past. So if we go to the next slide, we step back from expectations for Q3 and look at Q3 expectations in a broader context of where growth has been and what is expected for the following periods. So we have 2 charts side by side. The left-hand chart, as you could see, highlights 3Q18 with the 17.9% year-over-year earnings growth, and you could see that in the preceding 2 quarters, growth was extremely strong. So we mentioned the growth pace decelerating going forward, and that's a visual, obvious representation of that trend. And the last quarter of the year, and then in the first half of 2019, you see that this growth deceleration trend still remains in place. The right-hand side chart looks at the same data, but does a bit of a smoothing for the data. So instead of each individual quarter on a year-over-year basis, we are looking at quarterly data on a trailing 4-quarter basis. And in here, on a trailing 4-quarter basis, Q3 is a growth rate of 20.3%, and we could see that there is still some acceleration in the growth pace in the last quarter before we start moving towards deceleration. So any way you look at the growth pace, it is decelerating. Had it not been for the tax cut legislation at the beginning of the year, we would not have had the impressive growth rates that we saw this year, and we would have been in a more normalized, still strong, but more normalized pace. So if we go back to the earnings slide, yes. So this slide, so this is the earnings slide. Let's go to the next one, which shows the same trend for top lines, and we have the same year-over-year changes. The left-hand chart shows the revenue growth on a year-over-year basis for every quarter. As you could see, we have started decelerating from Q2's 9.8% top line growth, and we are going down in the following quarters as well. The right-hand side chart follows the same trailing 4-quarter format, and in there, the Q3 growth rate represents the peak, and then we start sliding down. So the takeaway from both of these, the earnings and the revenue pictures, was that growth has either peaked or about to peak, and we are moving towards lower growth rates compared to what we have been seeing in the recent past. This slide puts everything together. As I mentioned earlier, that had it not been for the tax legislation, growth rates would have been a lot smaller. In fact, at this stage in the earnings cycle, having been 8-9 years removed from the last downturn, a normal earnings growth would have been something in the mid to high single digits, which would reflect global revenues growth, which will be nominal GDP growth with changes to corporate margins. The tax cuts obviously gave us unusually strong growth in 2018, and that wears off in 2019, as you could see in the chart below. Still very strong growth, but not as impressive as in 2018, with the key risks being the outlook for the global economy and the wage growth in the U.S. economy. If the recent modest slowdown in Europe or in emerging markets continues or gains pace, that could be a risk to this earnings outlook. And the modest wage growth that we have seen in the U.S. economy, if that accelerates, then that will represent a risk to the earnings outlook as well. That said, what we are seeing here in earnings expectations is still a very, very impressive showing, and represents very strong top-line gains. Overall, a very positive for the market as a whole.
So, Sheraz, I just want to jump in here. With these revisions trending lower, at what point do you see a reason to begin to temper optimism with caution?
So That's why, Terry, I mentioned in one of the slides that even though the revisions trend is contrast to what we saw over the preceding 3 quarters, the magnitude of revisions is still modest relative to the historical trend that we've become used to over the last 4 or 5 years. And net, the corporate earnings picture still remains pretty strong. So to your question, if the revisions trend, the negative revisions trend accelerates and we see much stronger cuts to Q4 estimates as we start seeing companies report Q3 results and provide more updated guidance about business outlook, I think that will be a reason to be a little more watchful and a little more careful, and that will represent that the earnings picture, while still strong, it's not as strong as it was in the recent past.
Okay, thanks for that. And I want to remind our audience that if anyone in the audience has questions for either Sheraz or John, who's coming up next, all you need to do is type them into the chat box that's on your screen, and we will address those at the end of John's presentation. So, John Blank, what's on your radar as we progress through the final 3 months of this year?
Gary, well, I've got 3 key things I want to go through. First of all, I want to thank Sheraz for doing the earnings backdrop, because it's going to tie into my first question and answer, which will be about the overview of the current market returns. I'm going to then spend some time with ZRS slides that I've developed that you can later access on your systems. I'll talk through 6 points that make me frame my view of the U.S. equity market, and I will finish largely with the trade war story and give you my thinking on how to put this into play for yourself as an equity investor. So first off, let's go to my returns to date slide. Lo and behold, the first year-long returns are almost exactly X energy earnings growth that Sheraz provided you. So the bottom line with this market is, with all the risks that we talked about earlier in the year, they haven't amounted to anything in terms of redirecting people's attention from earnings. Earnings have mattered more than everything. The next thing down, number 2 to 10 in the ranking of risks, just basically didn't amount to anything. However, I want everybody to realize that was a backward-looking statement, not a forward-looking statement. And I'll finish today with the forward-looking statement of where the trade war situation can take us. But at this point in time, it's being ignored. That's the bottom line. Let's go to the next slide. Okay, so first half correction, second half rally. What caused the second half rally? As far as I'm concerned, the market basically priced a lot of risk in the trade wars early in the year and then took it down over time. So it was basically a risk reduction, return visibility type of rally, where people just said, oh, you know what? This isn't going to amount to what I thought it was. There was an exaggerated fear of the trade war, and it baked off. That's basically what I think. So let's go to the next slide. So here's my 6 ZRS slides that I want everybody later on their own to take a look at it with more concern and care that I'm going to get to. But what I'm going to point out is 6 points. One off is that the S&P 500 is fully pricing on a forward look 2019 earnings. So the deceleration in earnings that Sheraz pointed out is actually being fully priced now. It is aware of it, and it's already incorporated. The second point, U.S. Treasury yield curve compression. You've heard a lot about it, but we've got likely another year or 2 to full compression. We're at a 10-year spread basis, about 24 basis points. But we've got Mario Draghi getting out of the way in December, which is going to take a lot of the pressure off the long end. So we can basically stumble around at a very low yield curve compression for a good year or 2. Number 3, corporate tax cuts. They served to extend this cycle because they took out what was effectively a 21 PE forward look on S&P 500 earnings down to about 17. That reduction, that 20% reduction in valuation, which came straight out of the corporate tax cuts, probably eliminated the excesses in the market that may have tanked us. So in the midst of this year, we had Bitcoin crashing itself. We had all kinds of international chaos and White House chaos. And at the end of the day, the corporate tax cut took us out of any risky situation with that overrun excesses. Because at the end of the day, to get to a recession, we need to see excesses first, and we have not seen them. Number 4, revenue per share on the S&P 500. As Sheraz pointed out, it peaked in the second quarter. Now that's revenue per share, which is not entirely the same as the tax cut. So something else peaked in the second quarter, and this should cause you concern. Because a revenue per share peaked in the second quarter had nothing to do with taxes. It had to do with the weakness that started to creep in after the second quarter because of the weakness in the international economy. We just got notice today from the PMIs. Export orders are at a 2-year low now. So what's decelerating revenue per share is starting in the second quarter, and it's going to continue on, which is this creeping, insidious erosion of revenue per share coming from the international markets. The Russell 2000, you all know it's collapsed in the last few days. It's basically brought it in line with the S&P 500 now. Bottom line is the Russell got a little ahead of itself this year. Now it's back in line. I'm basically looking for the Russell to stagger around the rest of the year, but keep itself within a pairs trading environment with the S&P 500. And the final one is the share price momentum is picking up. We all see it. We all know the channel that the S&P 500 is. I don't think you should be alarmed by that. I think it's fine because earnings are tracking earnings growth and returns are tracking 1-for-1. And that's the ratio that doesn't cause alarm. A 1-for-1 tracking of prices to earnings growth is exactly what you'd like to see and is what we are seeing. So let's go to the next slide. Okay, first I'll go quickly through this. Look at this. The blue line's the S&P 500. The red is 2019 earnings. That's my point, fully priced. Next slide. Here we go. So look at the yield curve compression. However, look at how low rates are relative to the past 2 cycles. Greenspan got us up to 5% in 06, and in the dot-com era, we were at 6% on all rates before a recession. We're half of that. So we got a very accommodative environment still, regardless of compression. Next slide. All right, there it is. Look at that big hockey stick down. That's the valuation compression the tax cut produced. That extended the business cycle a year or 2. Next slide. There you go. There is your trade war effect. This has nothing to do with a tax cut. This is revenue per share, and that's what's creeping in. 43% of revenues coming from abroad. It peaked in the second quarter. This is something that we're going to talk about at the end of this whole talk. Next one. All right, we'll skip it. Next one. There we go. Look at the Russell and the S&P 500. This is showing you exactly what I'm talking about. Basically, since the first quarter of 2017, these two are walking in pairs. Pairs trading. The S&P 500 got a little ahead of itself for a bit. The Russell got a little ahead of the S&P 500 for about a quarter, and now we're done with that. We're going back to a much more standard, closer tracking environment. Slide 0.6. Next slide. There it is. So look to the bottom for the green and the red signals of when you should have bought and when you should have sold. Red being when you should have sold and green being when you should have bought. And you can see that we're basically in neither environment right now. And that's the point I want to make. It's a very contained momentum trading environment. It's not alarming to me in any way. Let's go to the final point that I'm going to make here, which is, all right, so as portfolio managers, what should you take away from my talk today before I finish up with the trade war? First of all, positive equity returns are very likely, but much lower upside going forward because of this revenue per share issue. I would equal weight large cap and small cap. I don't see any benefit to being out of one or in the other at this point in time. International is definitely going to outperform next year at some point in time. And that's the problem here. Timing will be key, and be very, very patient. I have not read any dialogue that says now is the time to get in. You get in too early. Just be late on international But be ready for international, because if you want to outperform next year, you're going to have to get in at the right time with international. Other points. I used to like healthcare stocks. They're still running up. I think they'll run up through the end of the year. Good time to take profits here and roll them into input tech stocks. I think the chip stock blowout is way overdone, and you can do a nice rotation here. I don't think you're in any rush, but in the next month or two, I would do that. And the final point I want to make is go to cash and CDs. Do not go to bonds for this exit strategy overall on your allocations for the next year or two. If you want to get out of stocks and book returns, just go to cash. Don't bother with the bond market. Let's go to my final points, which are about the trade war. Okay, first of all, number one, it's not showing up in earnings. Bottom line, it didn't end up anywhere. If it's going to end up somewhere, it's going to end up in industrials. That's why the Dow moves around more than anything, has more industrial stocks. I don't think it's put to bed. I think it's a 2019 and 2020 issue, and it's going to keep on growing. And I don't think we're going to put it to bed in 2 years. Now that the focus is on China, China is looking at the Japanese-American trade war of the 80s, which took basically 10 years, as the model. They're setting themselves up with a 10% cut in the renminbi rate to match the 10% tariff rate and last this thing out through 10 years, regardless of who's in the White House or how the House and the Senate breaks down. They are a 5,000-year-old civilization with a Communist Party government. They will last this thing out. They are shutting down any discussion in their public media about what's going on. They have total control, and they're not creating any alarm in the system within the country. So bottom line is they're planning for this to be 10 years long, and I think you should too. Now, as an economist, I want to point something out. Obviously, dealing with Lighthizer has been a good idea. The Canadians and the Mexicans did a great job with it. I think bottom line with both is they basically worked through Jared Kushner over the last 2 years and learned that he was the way in to the president's thinking. And actually, Kushner was a fairly moderate guy and pro-trade guy. And they basically closed NAFTA 2, not far from NAFTA 1. And they also basically roll in the European, the Japanese governments, which have security relationships with the United States, which makes things a lot easier to deal with them because they need us. And now Europe, Japan, and the United States are going to form a fortress, along with Fortress North America, Canada, and Mexico, and try to deal with the Chinese over the next 10 years. Do I like the strategy? I do. I don't think it's going to make a bit of difference for stocks other than taking uncertainty out of the market, which is helping. As we saw this year, the entire year was a risk reduction. Now we're probably in the trough. We're probably realizing this is a long-term thing. We'll probably survive it. We're probably going to get through it. So let's go to my next slide. All right, two things I want to point out. Trilateral talk. The joint statement on a trilateral meeting of the trade ministers of the United States, Japan, and Europe. This happened on the 25th of September, not long ago. This is basically a week ago. Go ahead and read this later on. It's a bunch of mumbo jumbo. Let's go to the next slide. I'll tell you what it says. All right. This statement discusses what they want to talk about a, quote, third country, which is China. The third country, we all know who it is, it's China. So here are the 6 things they're going to try to do. A measure to counter overcapacity, industrial subsidies, which the Chinese are out centrally planned. They basically pay their industries. Forced tax transfer enforcement to counter it. We all know about the intellectual property ripoffs. The WTO reform to include transporting and development status. This was actually in the Trans-Pacific Partnership, and they're recasting. It's a very conventional thing. E-commerce negotiations. Makes a ton of sense. We got to start talking about these businesses. This is Tencent. This is Alibaba. These are some of the biggest Baidu. These are some of the biggest things that can have to be related. Final one, trade-related national security. This is really has to do more with Europe and Japan and the United States and not China. But my bottom point is 5 of these 6 statements in the trilateral statement are about how to deal with China. And now you're seeing the model is solve a deal with Mexico and Canada, deal with the Europeans and the Japanese in a cooperative framework, and then all together go after China. So the next slide. All right, these are all the different trade war situations that are going on in the United States today with everybody. Obviously, the imposer in most of these situations is the United States. Not a surprise there. However, there are some surprising countries that you need to know about that are not in the news. One, Turkey. Turkey has doubled as high as 140% imports. They're not happy with it. That has to do with the Middle East. It has to do with a lot of things. Interesting point to know. European Union, they've actually brought in 25% tariffs and imposed them. So be aware that they have to roll things back at this point. We are in a trade war with them. And India is going to take effect on the 2nd of November. So regardless of what we do with China now, we're in a fight with India. So my point is, India, Turkey, the European Union, and China are the countries that are still involved in a trade war with us. It's not just China. And that is the final thing to remind yourself of, is part of the emerging market weakness that we've seen out here this year, particularly in Turkey, has been caused by the trade wars. And that's helped keep money flowing into the United States. It's kept this country's capital markets stronger than they probably should be. And I don't actually think it's going to go away next year. So it kind of inhibits that international rotation. And why I think, even though it looks like you should get into it, I wouldn't bother, and I certainly wouldn't bother until you hear that there's growth resuming outside the United States in meaningful ways month on month. So let's go to the last slide, and I will finish up and tell you that, by the way, Sheraz and I are in total sync about this. I just think, looking forward, continue to consider the fundamental erosion as what happens through the trade war. It'll be very, very diffuse, probably very weak, and very long term. I do not think it'll tip the market over, but that's my basic view, that it's just going to be happening in a very subtle way, and keeping people away from a huge bet on international markets longer than you think. And with that, I'll turn it over for questions.
Okay, John, you've given us a lot to think about here. So do I understand that trade is going to be the wild card with regard to the market going forward?
No, I don't think so, Terry. That I want people to understand. I don't think trade is going to be the wild card. It's going to be too long term. It's going to be an erosion in fundamentals that's consistent with the tax policy one-off, but it's not going to be the major thing. I think what people really need to focus on is whether monetary policy gets screwed up, and I don't think it's just the Fed getting too late, which is everything's focused on. The real issue may well be that Mario Draghi is getting out of quantitative easing 2 years before he should. He's leaving monetary policy in and moving towards less accommodation with still 8% unemployment in Europe. That is a long ways from help in Europe, and I personally think he's moved too quickly because he didn't see this trade war thing coming, and he hasn't adjusted. So I think the basic problem right now is the world is not adjusted entirely to the U.S. Hostility and trade war antagonism in its monetary policies, and that is where we have to see some address, because we basically have to see that bottom line is they have to stimulate their way out of this situation themselves, and I don't think he's going to do it, which is why I would be a little more pessimistic. But my point is, don't get over concerned with trade wars. Look at a lot of different issues in monetary policy and focus on PMIs, and wait till they turn for your signal on when to get international markets.
All right, John, thanks. I don't see any questions from the audience, so with that, we're going to thank our panelists for today, John Blank and Sheraz Mian. We hope you found what they've presented to you informative. If you have any questions regarding the services that ZRS provides, please feel free to email them to zrs@zacks.com. If you would like copies of John's or Sheraz PowerPoint presentations featured in today's call, again, the email address is zrs@zacks.com. Contact your ZRS representative directly. You could do that as well, or you could access these PowerPoints in the GoToWebinar Council. In the meantime, thanks for joining us. Feedback always welcome. In fact, after we close out here, you'll be prompted to fill out a 1-minute survey. We'd appreciate it if you would fill it out. Take some time. so that we can use your comments to improve the quality and content for future calls. And, as always, we look forward to the next time we all get together here on the call.